Hi, my name is Jeff Mandel. I'm the President and the CEO of the iQual Corporation and the ApprovalGUARD service. I'm here to provide you with a quick credit tip. Okay, your clients are ready to purchase their new home, but they're nervous about qualifying for a mortgage, or they're concerned about whether or not they can afford the monthly payments by getting a low interest rate. So what should they do? The key for your clients is to be proactive and to prepare. The ideal situation is that before they ever apply for a new home loan, they should perform a review of their credit report with a well-trained credit advisor. However, to the extent they have already been declined for the mortgage, it's still not too late to begin the process. They should first assess if there are any quick changes they can make over the next few months that could edge their scores up a little bit. First, either pay off or pay a little extra the next few months on any of their open credit lines. Second, improve the terms, either interest rates, duration, etc., of some of their debt by discussing options with their lenders. Third, evaluate options to consolidate some of their debt. Fourth, using their existing debt differently, can they change the utilization of their existing credit lines and or move balances from one form of debt to the other in order to improve the terms or the utilization ratios? These are just some examples, and everybody's situation is unique. The important variable is for each of your clients to proactively prepare and review their situation and to not only avoid surprises, but help improve their chances for qualifying for lower interest rates. 42% of United States consumers have credit scores that range between 550 and 699. As a result, these individuals, unfortunately, don't often qualify for preferred interest rates, and depending on their overall credit profile, they may not even qualify for certain loans and credit cards. The primary challenge is that most consumers don't understand what impacts their credit profile, and more importantly, what actions they can take to help improve it. This short quiz will help test how much you and your clients actually know about your credit profile and how credit scoring really works. First, to have the best impact on your credit score, you should try to keep your balances below what percent of your total credit line? 70%, 30%, or 50%? For example, if you have a credit card limit of $1,000, you should attempt to keep your balance at or near $300 to have the best impact on your credit scores and profile. So obviously, the answer is 30% or less. Second, what is the top contributing factor to what makes a good credit score? First, length of credit history. Second, amounts you owe. Or third, payment history. The number one variable impacting their credit score, it's simply paying on time. Third, credit scores are used by lenders mainly to A, compare you to other consumers, B, assess if you make your payments on time, or C, predict the likeliness that you will actually repay your loan on time. Your credit scores are used by lenders mainly as an indicator that you'll actually repay your money that they lend you on time. A lower score indicates that you are a risky bet, and for that reason, you may pay a higher interest rate if you are approved. Fourth, to establish a credit score, you must have at least one creditor reporting activity on your credit report for A, 12 months, B, 8 months, or C, 6 months. If you're trying to build your credit score, the answer is that you first must get approved and then use and make payments on the credit account for 6 consecutive months before your first score will show. If you find that you or your customers answered more than half of these questions wrong, you're not alone. In a survey, we found that the majority of people do not know the answers to these and similar types of questions. Actually, on average, United States consumers have a total of 13 credit obligations on their credit report. These include installment loans, which would include auto loans, mortgage loans, and student loans, and credit cards such as a department store, charge cards, gas cards, or bank cards. As a result of the numerous outstanding credit obligations, combined with the lack of proper knowledge and guidance about what impacts their credit profile, the average U.S. consumer ends up spending thousands of dollars on unnecessary interest expenses. The good news is that it's not too late, and with a good understanding and proper education of how credit works, you and your customers can actually learn how to effectively manage and proactively improve their personal credit profile before they try to buy their home. Let me tell you a little bit about the iQual Corporation. We provide advanced credit monitoring and advisory services that are focused on your customers' financial literacy and wellness through our branded solution, ApprovalGUARD. ApprovalGUARD helps your customers understand, evaluate, monitor, and optimize their entire credit profile, leading to improved credit profiles and credit scores of your customers, and ultimately helping them reduce their monthly interest expenses. You can learn more at www.ApprovalGUARD.com.